right, good morning. Today is Friday, September 6th, and I'm here with you just a little later than expected. I really wanted to catch something live in front of you today, but Doc is here with me in my office today, shooting some videos and doing some fun things. So I'm here with you just a little late, but I want to show you a really good trade setup that I've shown you in the past many times. The chart that you're looking at right now is the E-Mini S&P 500 chart. It's the day session only, so we don't see any Globex overnight trading, okay? Yesterday, Thursday, the 5th of September, the market closed right here at 1653. And as you can see, the market opened up a lot higher today, 1659 and a quarter, okay? 59 and a quarter, opened up 6 and a quarter points higher today, okay? And you'll see right here, yesterday's high was 1658 and a quarter. So I wrote that out for you, and this white horizontal line right in here represents yesterday's high. Now, if you recall back, I've shown you this trade many, many times in the past. When the market gaps up, we're looking for the market to fill the gap. So instead of just selling the market right out of the gate, what I typically do is I wait for that first 3 or 5 minute chart, whatever you decide to use. I personally prefer a 3-minute chart when day trading, okay? That's my personal preference. I wait for that first 3-minute bar to form, the first candlestick right here, right? This is the high of the first bar, right? And this is the low of that first 3-minute bar. What I'm looking to do, I'm looking to sell the market as it penetrates down through the low of that first bar, anticipating that the market is going to fill that gap. Okay, so the high of the first 3-minute bar is right here, and the low of the first 3-minute bar is right here. The low of that first 3-minute bar is 1657 and a half. Okay, 57 and a half. Now, if the market had taken out that low on the second bar, it would have been short. It did not do it. As you see, it did not do it. It matched that low, made a higher high. The third 3-minute bar right here, this one right here, was not able to take out that low either, right? So obviously at that point you want to sell stop. You want to sell stop the market one tick below the 1657 and a half, which is below that first 3-minute bar. So my short was at 1657 and a quarter. And as you can see on this bar here, it took it out. I personally got filled at 1656 and 3/4. So this little thin white line here represents where my sell stop was, and it's 1657 and a quarter, but got filled a bit lower right in here. Remember, a stop order becomes a market order once it's touched. So as you can see, the market really dropped off there. So I got a little slippage there. Now, my profit objective is going to be the close of the prior day at 1653, right here. This was the profit objective. So as you can see, the trade was a profitable one. Now, when you get into the trade, you want to manage that trade. So you're risking less than what your initial risk is. Now, when you first put the trade on, when you get short, as the market penetrates down through that low and you're short, you want to automatically put your initial stop loss, the ISL, above the high of the day up to that point, right? The ISL was above the high right up in here. Now, when that bar, the bar that got you into the market, right, the bar that triggered you short, as soon as it closes, which it closed right here, right? It closed right in here. You're going to immediately bring that stop down. The initial stop loss will then be moved to right above the high of the bar that got you filled. Right? So the initial stop on that was 1661 and a quarter above the high of the day. And then as soon as the market closed on the bar that got you short, it closed at 1655, you're going to move your stop down to above the high of that bar, which was 1658 and 3/4. You'd go to 1659 and a quarter. You'd move it to 1659 and a quarter. And as you can obviously see on this chart, the next bar was a huge bar. And this white line right here is the profit objective. That is your first profit objective. All the while, you're managing that risk by moving your stop down. So again, The initial risk was right above the high, and that was thrown in, right? That buy stop was put in place once you were short the market as the market broke down through the low. As that bar closed, you would then move that stop down to slightly above the high. You took profits here. And again, in order, trailing this market down, the way I do it is I trail it above the highs. As long as the prior bar's low is broken, I move it down to above those highs, as you see. Then we created what? We created an inside vertical bar, right? Isn't that a bar? Isn't that a pattern that I've shown you a million times on these videos? As soon as it took it out, you'd be out of the market. So that's really what I wanted to show you today. And again, I've shown you this trade setup many, many times. Again, when the market gaps higher, you're anticipating for the market to fill that gap. And that's how I play those gaps. So it took out that low on that fourth bar right in here. First profit objective was hit. Again, it's Friday. Have a profitable day, and I will be back with you on Monday. Hope you have a great weekend. Bye for now.